Welcome to Breaking News to Trading Moves. Today we're looking at a transaction that really acts as a barometer for the B2B financial technology market.
That's a good way to put it. Our focus today is the $8.4 billion deal for Clearwater Analytics. That's symbol CWAN. It's a take-private deal being put together by a pretty serious private equity consortium.
So for you, the listener, we're not just reporting a headline here. We want to figure out what this premium price tag is telling us about the market. What's the main question we're trying to get at?
I think it's really two things. First, what does this say about the appetite private capital has for these recurring revenue software companies right now? And second, and this is maybe the more direct question, with this new price established, who stands to benefit and which companies might be feeling a bit more pressure?
Got it. So our plan is this. We'll start with the facts of the Clearwater deal itself. Then we'll get into what that valuation really signals for the sector. And after that, we can run through the potential winners and then maybe the companies facing some new headwinds.
Sounds like a plan.
All right, let's start with what's on the table. Clearwater Analytics, CWAN, is being taken private in an $8.4 billion all-cash deal.
And it's the cash part that really stands out. Shareholders are getting $24.55 per share.
Which is a big jump.
A very big jump. The premium is the story here. It's about a 47% premium compared to the undisturbed price from back on November 10th, 2025.
So that's before any of the acquisition chatter started moving the stock.
Exactly. That's a commanding premium.
And who's the group of investors that decided Clearwater was worth that much?
It's a formidable group of private capital firms. It's being led by Permira and Warburg Pincus.
Okay, two of the biggest names.
Right. With more backing from Temasek and support from Francisco Partners, it takes a lot of conviction and a lot of capital to get that kind of group together for a software buyout.
And what about the timing? When does the company actually delist?
The plan is for the deal to close sometime in the first half of 2026. That's assuming all the usual things go through: shareholder approval, regulatory checks, that sort of thing.
But the message to the market has already been sent with the price.
Absolutely. That's already baked in.
Okay, let's talk about that 47% number. In this kind of environment, paying a premium that's almost 50% really gets your attention. What message are Permira and Warburg Pincus sending with that price?
They're sending a very clear signal. This deal acts as a, let's call it a valuation stamp on a very specific niche. The premium shows a deep belief in the durability of investment operations software.
We're talking about the plumbing, the infrastructure.
Exactly. Investment accounting, reporting, risk management, alternatives, workflows. These are things that clients like insurers and asset managers just can't turn off. They're mission critical.
But the public markets already had a price on this stock. Why did private equity see something different?
It really comes down to patience and how you structure the capital. Clearwater has this high-quality, very sticky recurring revenue.
High switching costs for their customers.
Very high. Now, the public markets, they tend to get nervous about high-growth software stocks when rates go up. They discount those future cash flows. Private equity, on the other hand, they can afford to look past the next quarter. They're paying for the certainty of cash flows 5, even 10 years from now.
And they plan to use their own investment to make sure those flows grow even faster.
That's the idea.
Can you maybe translate that premium into a multiple? What does that look like?
Well, the exact math is complex, but with that premium, you're looking at a forward revenue multiple that's probably north of 20x.
That's a high bar.
It is. But it tells the rest of the market, look, if you have this kind of essential must-have software, this is the floor for your potential valuation.
And injecting all this new private capital into Clearwater has to change things for everyone else in that space, right?
Oh, absolutely. It raises the competitive bar. Clearwater's management has already talked about investing more aggressively to build out a broader front-to-back platform.
So connecting the front office, where investment decisions are made,
to the back office for things like accounting and compliance.
Exactly.
And that's so important because
that's where the growth is. In alternatives, in complex risk analytics, if Clearwater uses this new capital to build or buy those capabilities quickly, it forces every other competitor to speed up their own plans. It just raises the stakes for the whole sector.
Okay, so if that's the price private capital is willing to pay, let's talk about who's happy about this news. Who are the winners here? I think we have to start with the deal makers.
Always. The first category is definitely the deal makers and financial advisors. A transaction this big, $8.4 billion. That's a huge undertaking. You have complex financing, fairness opinions, advisory work.
Which means a lot of fees being generated.
Precisely. We're talking hundreds of millions in fees for the banks and the advisory firms involved. And that activity just encourages more activity.
So which firms are we talking about here?
You're looking at the usual suspects, the big institutions.
Yeah.
Goldman Sachs, that's ticker GS.
Okay. JP Morgan Chase, ticker JPM, and then some of the specialist firms too, like PJT Partners, PJT. Their balance sheets get a direct boost from closing deals like this.
All right, so let's move to our second category of winners, the publicly traded private equity managers.
Right. This deal is validation for their entire model. When sponsors show they can execute an $8.4 billion buyout at a big premium, it just reinforces the story that it's a healthy environment for them to put their capital to work, and that's critical for raising their next funds.
So if they can deploy capital, it means good things for their overall business.
It leads directly to more transactions, more potential exits down the road, and most importantly, growth in their fee-earning assets under management, or AUM.
And the public companies to watch there would be the big alternatives managers.
Correct. This is a positive for firms like Blackstone, ticker BXKKR, which is KKR, and Apollo Global Management, APO. This deal is just evidence of a strong ecosystem where sponsors are actively buying high-quality assets.
Now for our third group of winners. This would be the other fintech companies, right? The ones who serve the same types of clients. How does Clearwater's valuation help them?
Well, like we said, it sets a new high watermark. The premium paid here forces the entire sector to recalibrate what mission-critical software is actually worth. It becomes a reference point for any other platform with those same sticky enterprise clients and recurring revenue.
So investors now have a reason to reevaluate similar companies that maybe the public market was overlooking.
Exactly. It can lead to a positive re-rating for those peers. If you're an established platform that's deeply embedded with your clients, investors now have a clear metric for your value.
And it puts them on a watch list for the next potential buyout target.
It certainly does.
So which companies come to mind that might see that kind of uplift?
You'd focus on companies that share those same characteristics as Clearwater. Think SS&C Technologies, ticker SSNC,
Okay.
FactSet, ticker FDS, and also MSCI. Their valuations are now being compared against this new benchmark set by a major private deal.
Okay, let's pivot now to the other side of the coin. For every winner, there's usually someone feeling a bit of pressure. Who might be a little nervous about this deal?
Well, we can start with the market operators themselves, which is a bit ironic. Every time a take-private deal happens, especially one this large, a publicly traded name disappears from the exchange.
So, the healthier the buyout market is, the fewer companies there are for the public exchanges to list and trade.
That's the irony, yes. It's a slow burn, not some immediate crisis, but it does affect the long-term growth potential for the listing venues. Losing a name like Clearwater matters.
And which venues does that trend affect?
This would be the big exchange operators. So NASDAQ, ticker NDAQ, CBOE, Global Markets, CBOE, and Intercontinental Exchange, ICE. They all rely on having a broad list of companies for their revenue.
Oh, what about the legacy service providers? The ones that compete in similar back-office areas?
This is a much more direct competitive threat for them. Clearwater now has a fresh injection of private capital, and it's free from that quarterly public scrutiny. That allows them to just pour money into accelerating their investment into new areas, especially reporting and operations.
Which puts pressure on the firms that were maybe moving at a slower, more deliberate pace.
That's it exactly. It makes things difficult for platforms that are maybe weighed down by older technology stacks. So companies like Broadridge, that's ticker BIR, and Fidelity National Information Services, FIS, they now have to contend with a newly aggressive, well-funded private competitor.
And for our last category, let's look at the strategic acquirers. We're talking about the big technology companies that often buy their way into financial services.
Yes, for this group, the pressure is all about the price of acquisitions. When a focused sponsor group like Permira and Warburg Pincus comes in with a 47% all-cash premium, it just dramatically intensifies the competition for any future deals. It resets the price ceiling for specialized software.
How does that high price change the math for a strategic buyer? Their cost of capital is different from private equity.
It makes their life harder. Strategic buyers, the big tech firms, they often use their own stock as currency, or they're looking for very specific synergies to make a deal work. Private equity can just come in with pure cash and a longer time horizon and outbid them.
So it makes future shopping trips much more expensive.
Much more expensive and much more competitive. For companies like Salesforce, ticker CRM, Oracle, ORCL, and Microsoft, MSFT, buying their way into these niches just got a lot tougher.
They can't just assume they'll get a deal because they're the big strategic partner.
Exactly. The Clearwater transaction solidifies the idea that if you want best-in-class financial software, you have to be ready to pay a premium cash price for it. So as this transaction moves toward closing in 2026, I think you should consider the trade-off it highlights. On one hand, you have the stability of the public markets. On the other, you have the high-growth capital and aggressive strategy that private equity provides. The choices being made here are really setting a precedent for whether the future of this B2B fintech space is shaped by quarterly earnings calls or by these multi-year, capital-heavy private strategies.
That's a critical point to watch as you look at the valuations of the other public fintech companies over the next year.
Thank you for joining us for this analysis.
And thank you for listening.
Disclaimer. This information is for educational purposes only. It is not financial advice or a recommendation to buy or sell any security.
The discussion represents the opinion of the author of the material reviewed. You should always conduct your own due diligence before making any investment decision.